Nifty Defense Index up 31 since Pahalgam attack. Should you still invest? What experts says. Talks of defense sector. Defense stocks have garnered significant interest among investors recently, following a cooling period after an exceptional performance in past 23 years. This renewed interest in buying comes amid geopolitical tensions after the Pahalgam terror attack on April 22 and the subsequent Operation Sindoor on May 78. Since the Pahalgam terror attack, the Nifty India Defense Index has jumped approximately 31, indicating a positive outlook due to the rising demand for military equipment like missiles and tanks. Bharat Electronics Limited BEL shares have risen by 28 during this period, reaching a record high of 393.50 rupees apiece. Meanwhile, Garden Reach Shipbuilders Engineers GRSE shares have surged 53, nearing 52-week high of 3,039.90 rupees apiece. Although these stocks experienced a sharp correction in late 2024 after their significant run, they have recently bounced back, driven by positive sentiment around recent events, argued Kaustubh Belapurkar, Director Manager Fund Research at Morningstar Investment Research India. Between FY17 and FY24, the value of defence production in India almost doubled to 1.27 rupees lakh crore, while exports grew nearly 15 times to 21,000 rupees crore. Today, the index constituents hold a combined order book of more than 3.5 rupees lakh crore, said Varun Gupta, CEO of Grow Asset Management Company. He noted that this is supported by improving financials, growing order books, and strong policy backing. Policy measures such as Make in India, defense procurement procedures, the positive indigenization list, a focus on private sector participation, and advancements in modernization and technology are key drivers of growth and investment in the defense sector. Prasanna Pathak, managing partner, the wealth company Asset Management. Nanan experts expect defense stocks to cool off and consolidate in the coming months as geopolitical tensions ease. They note that many of these stocks used to trade at 1,015 multiples but are now trading at 4,050 times PE multiples. Therefore, future returns will likely be driven by earnings growth since most PE multiple re-rating has already occurred. Given the current geopolitical situation, it is widely expected that the defense sector will remain in the spotlight for at least the next 23 years, and the current multiples are likely to sustain, Pathak added. The Indian government also prioritizes the defense budget, with allocations growing each year and more than doubling over the past decade. Recent geopolitical events have sharpened the government's focus on national defense and reinforced its strategic importance, Gupta believed. Nanan experts view defense as a long-term structural story but caution retail investors to be careful. Retail investors, Pathak said, should exercise caution when investing in sectoral funds as the portfolio is concentrated in a single sector or theme. These sectors experience up and down cycles. Sector thematic funds tend to have extremely concentrated exposures. This is particularly true for the defense index, where the top 3 stocks account for over 50 of the index and the top 5 holdings for over 70. This concentration makes the returns of the fund's index very dependent on the price movement of only a few stocks. Investing in these funds carries timing risk, making entry and exit timing crucial. Only investors who can take a fundamental view on the underlying stocks should invest in these funds. Most investors are better served by investing in diversified equity funds, suggested Belapurkar. Swipe left for next video. Gupta recommended SIPs as a prudent way of participating in this long-term growth story while navigating short-term volatility and elevated entry points. Disclaimer: the views and investment tips by experts in this News18.com report are their own and not those of the website or its management. Users are advised to check with certified experts before taking any investment decisions. Latest blogs